current climate. Crispin, it's an absolute privilege to have you on the Monday call, and I'd love to discuss with you current market conditions and for you to give us some insights into where you think markets may be heading. We could perhaps get out the crystal ball, but perhaps to kick things off, Crispin, it would be great if you could tell us your story. How did you get to be founding OD Asset Management in 1991? What's your background and what's your journey been?
Yeah, I started life as a barrister, but before that I read history and economics at Oxford, and so then did the law as a second degree, and then joined the City. Perfect timing, really, in 1982-83, which was after the beginning of interest rates coming down and the stock markets going up. And it's worth remembering, though, that throughout the whole of that 80s period, the returns for investors in equities were 17%. They were staggeringly good per annum. But at any one moment in time, you could have lost all 17% within that year. That was just because, as always, when something is new and it's a new trend, it doesn't have a lot of conviction behind it. So anything that could hit it did hit it. And therefore, there were a lot of people still, even in the 80s, who didn't participate in equities, despite these wonderful compounding results, because they were scared that they might buy at the wrong moment. And I basically I started a small group called Framington, which came out of a stockbroker. I started with a very famous fund manager called Anthony Milford, which was great. And again, it always helps to learn from a master. And I then joined Barings because in 1985, got married to an Australian girl, little princess, like they all are.
We won't hold that against
That's right. Got divorced before you start holding it against me, quite soon after. No, 2 years later, James. And basically, and when I joined Barings, it was the international side, so it was much more exciting than the traditional merchant bank, because it came out of Hong Kong. And so it had that sort of entrepreneurialism, and that was wonderful. And I worked there until 1991. But while I was there, I ran a top-performing unit trust, which did well not only in the good times, but also, more importantly, when in 89, the first kind of recession since 79 came along. And I performed well into that whole period through, which meant that and the problem that Barings always had was I was running the money. It was continental European money. I was running the money, running the clients. I really, in a way, it was my own business. And when they became quite difficult, I said to them, look, actually, I might as well set up on my own. So I was very unusual, because I don't think anybody had set up a fund management operation at that moment without having the backing of an insurance company or a bank. And I didn't have either of those. I just started with £120,000 of my own money. But I did have the backing of Soros and of Gilbert de Botton and Tudor Jones as well. So, and a bit of Julian Robinson's money. So I was. They came to me then because they said, you've obviously shown yourself to be quite good, but do you know how to run a hedge fund? And I didn't, but when they told me what the fees were, I very quickly did know how to run a hedge fund. So really everything was about reverse engineering. When I started the funds in 92, I left in 91, set up this company, but in 92 was when we first started. And I had a very good run, primarily because, in fact, people forget, but Japan had just started to go wrong in 1990, and a lot of people saw that Japan was the rich country in the world, and if Japan was having a bad time, surely everybody was going to have a bad time. And there was a lot of talk in those days about contained depression. so most, and over that sort of next year, I think I must have met every billionaire across the globe who came into my office, and most of them were exceptionally bearish and were wanting, therefore, to have a fund that would do well in a down market. And actually, I was pretty optimistic at that point because debt had been crushed. So actually, I made a lot of money very quickly, being very bullish, despite the fact that all my clients were very bearish. And I'm sure that's often happened with everybody else in New Zealand as well.
Did they almost invest with you because they thought you were going to be bearishly tilted, but actually you were pretty optimistic? Did you tell them that?
Jason, well, you tell them nothing. No, I didn't tell them. I'm not in the mushroom game. I mean, the answer is I told them, I listened to what they had said, and then I told them what I was going to do. And they sort of hoped that, I think they hoped that, what they one of the interesting things, and it applies now, is I remember when I was being interviewed by Soros because they wanted a partner, and I didn't want to be a partner, but I wanted their money, and so there was lots of conversations, one of which was with Druckenmiller. And at the time, Stan, he sort of said to me, well, how well are you doing? And I was quite pleased because my fund, the markets were up around about 14%, and I was up about 29%. This was on the year, and we were probably talking sort of about May, June. He didn't look very impressed at all. And so I thought I better ask him how well he was doing. And he said, I'm up about 91%. and at that moment I thought, even if I had only had chosen one stock, I could never have been up 91%. But the fact was, James, that the reason he was up 91% was, his money was in 4 different buckets. So there was a bond bucket, there was an equity bucket, long and short, and then there was a currency bucket, and then there was a commodity bucket. So the answer is you could, if you were making 20% in each one of these ones, you were making 80%. And you were, I think when I first, set up, what absolutely intrigued me was I was very close to a whole lot of people who had been doing this for a long time, who understood exactly how you got that transmission from one asset class to another asset class, and how you could handle that. Obviously that has a relevance today. Over the last 2 years, I've probably made 200% in 2 years. I mean, but for the clients. But the fact is, actually, again, remember that this is all broken down into different buckets, and so it's different returns in different places, and that's very important.
Was that first meeting with Stan Druckenmiller kind of a eureka moment where you realized that actually there were so many different asset classes that you could be investing in that you needed to change your approach, or were you already going down that track to begin with?
I had tried, when I had been at Barings, I had started to because the whole of that 89, 91, I mean, it was really the last major recession that we had, and all of us felt it. And the fact was that you couldn't really have a steer on your equity book unless you had some understanding of where you thought inflation and interest rates were going to go. And it has, and so I had been trying to find a way of using my economics background to better effect, to put that into a portfolio, but I didn't really know how to do it, and that's where the light went on, and it was undoubtedly. I mean, Soros stayed with me till 1997, and I had I owed them a great deal, but they didn't like. I remember sort of being very quickly told by George, he hated neophytes. All I was a neophyte. I sort of, but there was, to give you an idea of the kind of culture in this place, there was a Christmas party which I went to, and one of the, where I was there, and somebody came up and said, "Oh, George, thank you so much. We're all having such a great time." George said, "Having a great time is not my idea of having a great time." So this was a place that no one ever smiled, actually. It might as well be the more. But there was, what I also, found interesting was slowly, it was trying to understand how you fashion risk as well, and you deal with risks as well as with return. And in one sense, you can say that I've never really understood that. Because I've had two periods in my career. They were pretty bad, and one was in 94, and I lost pretty well 50%, and another was in 2015, 16, and I lost about a bit more than 50%. But the truth is that both of those, strangely, they had some sense to them. In 94, I lost all my money because I was forecasting that the deflation, the inflation that everybody got used to in the 60s, 70s, and 80s was coming to an end, and that we were into a deflationary period, and understood then that China was changing the world in terms of a post that devaluation in 1994, and that sort of leading into that, but in what was interesting, and the answer is therefore I bought far too many of the long end of the bond market and basically said, this is the easiest way to make money for the next 20 years. And in 2016, 15, 16, I was looking at China and realizing that China was going from having been a wonderkind to being somebody who was making big and grave errors in terms of their asset allocation and where they were and what they were going to be able to do. And the trouble was that in 94, nobody else really understood the deflation. So the long bonds, which I sort of bought on a yield of 8%, went down to 5 and went back to 10. Equally, the opposite really in 2016, when actually it's now that China is sort of where it is rather than in 2015. So it goes back to this problem of timing. I think it's it's the important thing about understanding when that timing is right. And that's why we're here today, actually, because if you are right about major trend changes, and that's what my background is, then these trend changes do have a very long time period to them, James. And what was true that 1994 was a horrible year for me, but the truth is, it meant I was understanding what deflation was about for the next 20 years, and I was in position. And so the truth is, I lost 50%, and then I made 500% over the next 5 years, and that was, and I carried on making money, and it meant also that I really did understand again what was going wrong after 2004-5 in terms of the property, where the deflation was now starting to ensure that there was going to have to be a massive great bankruptcy. And the longer that went on from 2005, the more that we realized how big it was going to be by the time it hit. And it was a very simple one. It was very easy to understand, and that was interest rates were at the wrong price. They were globally about 5%. I'm sure they were about that in New Zealand in that period. Everybody was basically, the way in which all the central bankers were keeping the consumer alive in the West, given that that manufacturing was being eaten by the Chinese and the deflation coming out of China was intense, was to encourage people to buy their own house and basically spend the money that they were making on their house price increases. And they got rid of the redemption yields and term structures. They did everything they shouldn't really have done, but they did it in order to keep things going. And the problem was that, the real return on housing is a 2% return. And the problem was that everybody was borrowing money at 2 over 5, because 5 was the LIBOR rate, so 7% interest rates, and investing in an asset that had a 2% return. And they were leveraged 4 times. So the answer is they needed house prices to keep going up by 20% in order not to get bankrupt. And all one was doing really from 2007 onwards was saying, hey, this will work very well until it doesn't work. And that's like all bubbles, and we've seen it in tech again in the last couple of years. And when you get that, it's very, very difficult sometimes to in 05 to 08 we really protected ourselves despite the fact that we could see what was going on. And what happened, and it's important this, was that our loan book was making us 25% because we were understanding that there was still a global boom going. And in fact, if you remember, it was a commodity boom in that period, 06, 07. But we were also preparing ourselves to make a lot of money on the shorting of financials and banks. But they were still going up. So we had kind of 2 years where we made a bit of money, but if you looked at it, the longs made 30 and the shorts lost us 20 type stuff. And you had the same for 2 years. And then the third year, the longs made us 30 and the shorts made us 30. And that was suddenly going from making 10% returns to making 60% returns. And you're on both sides of that. And then and of course, what then happens is when the crisis is taking place, it is always much faster and quicker than people understand, and therefore, most of us can't think and act at the same time. And so, if you've done all your thinking and it's taken a long time to come along before it's happened, you benefit enormously from having had all that time to think about it. And so you can put the trades on, and it's pretty easy to make the money that you make. And the answer is, you make it very, very quickly. That was the point about 08 to 2010, 11. I think we probably made 250%, everybody else losing their shirts. And so it is, one of the things about it I find with my investment style is that it's one of those, you take a look, it doesn't happen immediately. And the fact it doesn't happen immediately, you no longer hate, because it just gives you the time to really think about how best it's going to work for you. I.e., it forces you probably to improve your game a lot. So
is that what you're doing? Is that what you're doing, Crispin, in the intermediate steps? I mean, in some of those, like you said, it's all about timing, and I guess timing also is linked to how big a position you put on, because if you're wrong well, not wrong, but if it's taking a little bit more time for your thesis to play out and you've got quite a big position, that can be really painful. So what are you doing in that intermediate step before it starts to work, in terms of, are you chopping and changing and trading, or are you sort of hands off the tools, you've got the right position, you're leaving it somewhat, and you have to be patient?
I think you have to be patient, James. I mean, the truth is that, what you learn is, do not, given that one's contrarian, do not put these things on until you really see so many things turning to your advantage. Usually, the strange thing is the price sequence is the last thing that happens. Everything else is kind of come into line. But even there, what you're doing is you're moving very quickly when the prices are also starting to just feel it. So because you do not want to be on the wrong side of these things, you just can't afford it. But there is this other side of it, which is that you mustn't. In my world, your biggest position has to be right at the start, on the start of its decline, not at the end of its decline. And that is why almost everybody else has given up shorting, because they basically found themselves too often, having too large a position on a short, which they absolutely believed in, that it wasn't going to work, but that they were wrong on the timing. And my point with the .com, with the growth stocks, with the tech stocks, was everybody was wanting to short the tech stocks, but it suddenly became obvious that the thing to short was not the tech stocks, but was the long-dated bonds, because the long-dated bonds were, they were yielding 0.5% 40 years out. So that's the equivalent of 100 times earnings. So, given that the bond market was at 100 times earnings 40 years out, actually you couldn't find a growth stock which wasn't fantastically cheap on their expected earnings growth against that 100 times. And I think that was the important point to me, was say, don't short the equity market and the growth stocks until the real short position that should be established was in the bonds. Because the fact is, again, that we do live in a world of fiat money, and New Zealand is famous for having invented the idea that you keep following where money, where the inflation rate is, all of that sort of early stuff, nearly 25 years ago. But the fact is, where we are today is we are the opposite end of where we were in 1982. Is my point. Is we have enormous amounts of leverage which have been taken out because interest rates were so low. The authorities are completely obsessed and scared by this leverage. So therefore they are totally unwilling to allow any kind of recession to take place, because they worry that there would be debt deflation at some point. So actually, that's very like the early 70s, when so we can see across the board at the moment interest rates at 2% being held, or 3% in the US almost, being held as being the peak and ready for a pivot, even though RPIs are fast approaching 10%, and certainly in the UK will hit 13%. The fact is, my cry about all of this is don't look in those terms. You've got to understand that from the authorities' point of view, they have for the last 12 years, what they've hated was, yes, interest rates declining and QE coming in solved a lot of the problems of a depression, but did encourage too many people to borrow money, and therefore the leverage is too high. And what they are getting now is a period of time when nominal GNP is rising faster than nominal lending. And what does that mean? It means incomes are rising relative to debt. And if you're the authorities, you would like this to happen for 5 years. And how do you get that for 5 years? You do it because you don't allow interest rates to catch up with inflation rates. And you really secretly are encouraging inflation through the system. And that is really also reflects the fact that on the back of the Ukraine and massive underinvestment thanks to ESG in resource areas, we are into a period when real incomes are under pressure. And the point is, in a political world that we're in, the way in which that is relieved is by wages growing, but they're not really, in real terms, growing, they're falling. And I think this is the heart, James, of the next 10 years for all of us, is that you have got to understand that the real value of money is declining quite fast. And the nominal value of money is rising. Yeah.
This is your, I guess, the contrarian view, and why this is such perfect timing talking to you now is because you've seen equity markets do this, quite aggressive bounce. Some people are calling it that's it. Some people are calling it a dead cat bounce or a bear market rally. But it's because there's some in the market have this expectation that inflation is going to come rocketing down, perhaps because we enter a recession, and that's the end of increasing interest rates, so shares can go up on their merry way. And your view is, hang on a second, and like you were saying, and when you explained other periods of time where you've been really successful, is, hang on, this takes a lot longer than you think, and we've got a lot of wood to chop with inflation before we can even consider interest rates coming down.
And you're so right. I mean, I just remember, in 1989, 1991, that period just before I set up, it was really highlighted because the UK joined the ERM in 1989, and we joined the ERM at a set rate. And that year, which was a recession year in the UK, wages grew by 9%. And so whatever rate we had got into the ERM at, we were now 9% more expensive relative to the Deutschmark by the end of that year. In 1990, a real recessionary year in 1990, wages grew by 8.5%. So now we were 17.5% out. In 1991, which was another recessionary year, wages grew by 8.2%. So my point is to say that the idea that a recession, as forecast by the Bank of England yesterday, which is incredibly mild of 2% over 2 years, is going to do the trick and to stop wage growth in its tracks is rubbish. It's completely accepted by the market. There is nobody who has anything other than a 3% inflation rate penciled in for 2 years out across any major developed economy. And my point about that is you can see how entrenched that view is in one of the charts that I thrown, which was showing you how index-linked have managed to perform just as badly at the long end as the bonds. I mean, it was very easy to see if inflation was really going to come through the system like we've seen it, that buying a bond that yielded 0.64% was not going to be a very clever place to defend yourself against inflation of 9-10%. But you would have thought, if you had been at the start of this year, that buying up an index-linked bond at 100, and when the RPI would turn out to be 9.1%, would have looked a good trade. But in fact, you lost just as much. You lost 50% in that trade as well as on the conventional. That is the most amazing bit, because the reason the index linked has fallen by 50% is because the expectation is that we might have got 9.1% RPI, we might get to 13.3, which is what the Bank of England is saying we'll get to in October when the gas prices come and electricity prices come up. They're forecasting that it will be under 3% by the end of next year. And therefore, because it's under 3%, the conventional bonds are yielding 2.2%, which is a minus of 0.8, and that means that the index linked are at kind of minus 0.8% real. Now, my point with that is to say, actually, if you believe which is hardly a difficult one, that inflation won't get back to 3. Even if it would go back to 4, I think it'll be much higher than this number, but it just shows you, if it got back to 4, then the conventional bond yielding 2.2 is really wrong and needs to be 3.2, which is another 33% fall in that conventional bond. But the index linked itself then needs to be another 30% higher, because and this is something which is pretty unique to the UK market again, is that our bonds are exempt as an asset class in the UK, gilts, because the original thinking was that they're issued at 100 and they're redeemed at 100, and whatever happens between those 2 dates is sort of consenting adults and doesn't really and therefore should not be subject to any kind of taxation. Now that's all very well when you have something like a conventional bond. When you have an index linked, you have something very different, don't you? Because in a way, what happens in an index linked is the RPI number gets added to your redeeming capital. So strangely, with index linked, you're turning income into capital. It's not dependent on your being it's the asset class. It's not the person who owns it that matters. And my point about this is to say, actually, if you believe that we are at the beginning, which I do, a long period of higher inflation rates and messing about, there are 2 things that stand out. One is that that equities may be okay in nominal terms, because they will just reflect how inflation is coming through the system. But the real value of money will be falling very dramatically. And I want to find a way, which I think I have found, of collecting that fall in the real value of money so that you as investors can actually harvest that. Because my point is to say, James, that most fund managers are sort of look at and think, I'm sure you have it at your place, but a couple of weeks ago, one of my fund managers just came along and said, "Look, Kristen, have you seen what the RPI has done over the last 10 years? Sort of go bottom left, top right." And he said, "Have you seen what my wage has done?" And he said, and it went across a straight line across the bottom. And I said, "Yes, but have you seen what your fund has done?" And I said, "I'm afraid your fund pays with your income." But it's a very important point in a way, James, which is to say, actually, we're probably looking at the wrong thing. That, for clients, we're really always trying to preserve the real value of their portfolios. And the real value of that portfolio is obviously inflation adjusted. And that means that, certainly in the UK context, that actually we need it to be up 10% year on year.
Yeah, exactly. Up 10% year on year has actually just been an inflation protection only.
That is just inflation protection only. So I'm just saying to you, what is fascinating is most people are fighting the wrong battle already. Because they're trying to protect themselves against zero. So you've got to really think, how do I protect myself? And why, that obviously for me, for the last 2 years, the bonds have been they've been helpful, and they will remain helpful. They will continue to provide a consistent returns actually for us. But the point on top of this is to say, actually, if we are, what can we really be assured are we short of and going to need to spend money on? And it, as Coleman said at the Tiger Funds thing yesterday, that what he got really wrong was inflation. And why he got inflation wrong was he thought that technology had done away with inflation, that everything was getting cheaper. And that was just, that we all know that actually, the two most important parts of people's living costs are energy and food. And it's energy, and the trouble is, if we are choosing to try and make the world more renewable, the trouble is with that is we know we're playing with the efficiency of energy. Because we know the most efficient ways of creating energy, and we are choosing not to do it in the most efficient way because that we can't afford it. But the point about that is, who pays for that inefficiency? Well, I'm afraid it is always the consumer, and it is always in inflation. And so, so much of what we're talking about is really, it's so endemic now in the way in which we're all thinking, that you've got to put it into your system as well.
So, Chris, when the Bank of England says, inflation is going to be 13%, and we're going to go into recession, but then, as you said earlier, politically, wages have to go up. The pressure on politicians to increase wages. Do you think, and maybe this is UK based, but I think it's comparable to at least New Zealand too, with this demand on wage inflation, and the wages that are going to go up are wages of people that generally spend all the increase. Do you think actually the recession is actually harder than it looks, because although you have increasing interest rates, you've got increased spending?
Yeah, I think it's exactly the point that, all we've seen is a rise in the cost of living for the first half of this story. The next bit is that actually wages, because of unemployment being as low as it is and so difficult to hire people, you've got to provide wage increases. And the problem is, and this goes to the heart of this thing, is that because the tax man sits in the middle of wage increases, if your cost of living has gone up by 8% or 13% by October of this year in the UK, a 13% wage increase isn't enough, because 3 of that 13 goes to the government. So you need a 16% wage increase. And similarly, the point is that if housing is 7 times average wages, and the 66% mortgage loan to value, then actually a 1% increase in interest rates demands a 5% increase in after-tax income for the individual to be able to survive. So there are just now so many areas of the economy which are demanding that wages rise. And the one thing that is not, one of the points that, the Bank of England's hope is at, is forecasting that rise in wages. So my cry, which is St. James, I think in the second half of the year, the recession will be that much less, but the inflation rate will be that much higher than people forecast. And that's why we're in such a good moment here, because strangely, I've never known people have such pathetic views as we have today. We have, as you rightly put it at the beginning, you have one group of people who say, this is all over now, we can get back into the game. And I'm afraid you have me saying, this is, the problem with a cost of living crisis like we've had, as it was in the 70s with the oil crisis, is it leads on because of the West. No politician will allow anyone to basically have their living standard fall by 10% in a year. So they kind of help out. And therefore that 10% becomes an inflation number, which is inflated over years. Because once you get into the wage increase driven inflation, you are really in a different game again. Because all of this has been a goods inflation, but we're about to go into the service sector inflation. And then, and at that moment, the idea of owning a bond or anything else becomes absolutely anathema. And strangely, at the same time, I think people really do go back to thinking, there is a shortage on the planet. Once you're back into worrying about shortages, you start buying different things in the portfolio. And we know that the average portfolio across the world equity portfolio has got less than 3% in commodities, even though commodities are around about 12% of 15% of GNP. So they're massively underexposed to oil or any of the other commodities. And our point about that is saying that's part ESG, part the idea that, for the last 15 years that technology rules the roost. Because and my point about that is saying, what we're really talking about is in a hierarchy of needs, going back to understanding that actually anything that makes energy transformation inefficient actually is productivity. It means productivity is going down, not going up. And I think that what was interesting about the 70s was that very few hedge funds came out of the 70s successfully. They kind of followed, they'd either tried to be too defensive and too short, and they certainly didn't really understand how inflation was going to come through the system. And my point about it is to say, one of the things you've really got to have, and I think it's important for clients, is that I'm really looking to have pretty high yielding portfolio over the next few years, because it's going to be that cash flow which allows the client to spend the money, or the investor to spend the money, or me to find different things that we want to spend the money on. And the classic one at the moment is obviously post ESG. Coal assets have been thrown away by a lot of major multinationals, etc., and they kind of trade on 2 times earnings. And yes, coal price has gone up a bit, but the fact is, coal sits there at about $32 a barrel equivalent of oil. And if you are Japan, post tsunami, you have got to buy that thermal coal, and you will be buying that for the next 7 years and the next 15 years. So and moreover, you can see that with China as well, and you can see that Germany is coming back.
I've got to say, Germany's coming back to
buy
coal as well. So
sorry.
No, I was going to say, so it's a really interesting. I mean, the setup is phenomenal, and when I think about it, how fast things have happened. Actually, there's still so much water under the bridge to go, even some of the supply chain worries and around COVID. But when you fast forward and think about all the lack of investment from ESG, this commodities cycle looks like it could be setting up to be just as strong as the one that you mentioned earlier in sort of 2006, 7, 8.
Yeah, well, that's what I mean, and it's even strengthened. Obviously, we've seen a tightening in monetary policy in the last 2 quarters. And with that, we've seen commodity prices coming right down again. And my point is, that kind of gives entirely the wrong signaling to those industries in terms of CapEx. Because they've got soaring cost input increases thanks to fertilizers in the case of and potash in the case of the soft commodity guys, and obviously the cost of basically power and fuel for the hard commodity guys. But the answer is, it's this problem everywhere that the governments are still in the game of giving the wrong price signaling to get what they want. And how can you have a situation in which people are using the old mantra that basically shortages of supply create their own solutions because the price goes up and everyone comes to and solves it. Well, I'm sorry, that is not happening. And as you say, James, that is, in a strange way, the longer that doesn't happen, then the more that we will make in terms of profitability. And that's really what and what I love about where we are today is that, we're just finding lots of companies that are just at that sweet spot, the other side of, I was talking to you about how it's not getting a solution, not winning immediately. Often it means that you have to be more imaginative in your solutions, and that works. And I think I mentioned to you the other day, but it is this company called Cadiz in California, because I think it absolutely epitomizes everything that we're talking about, and that is that 30 years ago they found that there was an underground reservoir which is just on the edge of South and North California, and they basically tried to get it, the water pumped straight into the Colorado water system, but they were seeing that there was, desert foxes were going to be at risk, and the old owl would never appear again. And they didn't really know, but they felt that this was going to. And what happened was the senator for California, one of them, Anne Feinstein, became the desert queen, and she decided, no, we're never going to allow this to happen. Now, the strange paradox of this is this thing started, it was 30 years ago, and at that point in time, the water price was about $100 a water litre, and it's now $2,000 a water litre. So that it's been more valuable, that it's never been used than it's been used. But the paradox of all of this is that it actually forced them to be much more imaginative than they'd been, because they originally just saw this block of water and said, well, let's sell it. Actually, what they then realized was that the best thing they had was that they were on the watershed between the north and the south of California. Now, the fact is there's no shortage of water in the north of California, and there's a massive shortage in the south. And the Mojave Desert, which is where this lake is, there is, to the north of it, there's the Mojave River, and the Mojave River floods as in today's world, whenever you get water, you suddenly get too much of it. And so the flooding basically means you get flood water. And now they realize, actually, we can bring that flood water up into the reservoir and then bring it down into, so much better. No, you're absolutely nothing. The desert foxes say the mountain owl, whatever it is, but yet, of course, and now we're at that point where the interesting thing is, as of yesterday, we have offered water to the poorest communities in South California, who we're not allowed to deliver it to them because the politicians above them are stopping this from happening. So we're just putting pressure on both sides now. At this, if once we get this thing operating, and which we will do, it will make us about $80 million. It's not an enormous thing. It might make us a lot more than that, but I'm not being too optimistic. But the answer is the market cap's about 200 million. This thing is about to happen, and it's called Cadiz. And the weird thing about it is that it's taken 30 years for it to happen. Now it cannot be stopped because it is both green, it has solved its problem, and it's regenerative, and my point about that is saying it should be at this point in time, very expensive. We all know that water is going to be one of those things that is going to be expensive. But because of it, strangely for these guys, the share price, if you looked at it, you would think that this thing hadn't happened. So it fell from $14 to $2. even as this some new wave was coming through. So you were buying it not only, this is back to your thing, James, not only at a point in time when the new trend had just been established, but also you were buying it, at 20% of what anybody else had been buying it at for the last 3 years, for the last 20 years. And those traders, and that's waiting. I had owned it 20 years ago. I'd owned it various different times, and each time I kind of felt it wasn't yet the time. But now I think it's absolutely the time, and and that's when you make your money.
Crispin, what's been really fascinating about you describing the market and what's happening is it's almost like a really sophisticated orchestra where you've so graciously moved from one asset class to another to talk about the opportunities. Not once did you step back and go, things are really nerve-wracking and dangerous at the moment, I'm stepping out of the market and going to cash, which, by the way, would be the worst asset class you could probably go to. What you are doing, though, is you're reflecting the environment, and these sorts of environments provide amazing opportunities that come up not every year, but come up every decade or so. And there's lots of different ways to play it, whether it's through bonds and interest rates, whether it's through commodities, whether it's through individual companies. And the art, I guess, of the conductor is putting it all together and making sure, like you said, the timing works.
It's very much that. I always remember, though, there was a moment when I'd done incredibly well, and Nicola, my wife, my ex-wife, now, but it was and I said, look how much money I've made you. She said, you haven't, it's not you haven't done well. I said, well, what do you mean? She said, no, I made the decision to invest. I think JC was, but the interesting bit, as you say, is when you have a market, when it's a new trend, it's a trend that people don't really understand. And going back to the 80s with inflation, because of what had happened in the 70s, nobody believed it. And similarly now, nobody believes in inflation again because we've had really 30 years of no inflation. And it just, we all know that, from people in the office, that if you're under the age of 35, you just would never buy anything that we're talking about. You just wouldn't. You think everything, is about the future. We don't believe that everything's about the future. It's just the future is a much more complex thing than they are thinking it is. And I think my cry is to say, remember that there will be volatility in these things because people don't really understand what they're in, just as they didn't really understand in the 80s what they were in. The risk to all of this is that there is a cycle, and that cycle, in a world of fiat money, we've been, the two things that have really been crucial for the last 30 years have been undoubtedly the entry of China into the commodities market, into the goods market, in terms of what that did to pricing for a very long time, and the downward pressure and the improvement in the living standards of everybody thanks to all of that. The fact that as a result of that, and the way in which we commodity prices came down, and energy costs came down, and that drove lots of the productivity gains. We all know that when you look at solar and you look at wind turbines, etc., the big element in there in the manufacturing costs is energy. If energy goes up, it actually drives up their costs. So actually everything becomes more expensive. And I think it is that very good, I think it's understanding that the problem with where we are today is once inflation starts entering this system, there are lots of things which stop being good once they're starting to rise, including interest rates. That, there's a great New Zealander over here who was called Brian Redding, and he was the first person I knew who always said, interest rates are inflation. A rise in interest rates is a rise in inflation because it's a fixed cost. Money is a fixed cost. It's not a variable cost. It's a cost you have to take, and therefore, if it's rising, you pass it on. And I think this is all I'm saying to you is, and I'm saying to investors, is you really do have to think in a different way into this next phase. And I have one of my problems with the companies that I invest in is lots of them haven't yet woken up to any of this. I have two companies who have been slugging, trying to destroy each other for the last 5 years in the UK market in electronics and electrical goods. One's called AO World and the other one's called Currents now. It was Dixon's. And the answer is they're backward thinking. Both of them make absolutely no money in the UK, and they fight each other to the death. And I keep saying to them, look, you fail to understand that dishwashers and washing machines are no longer, for years, you had a situation where you expected the price to come down by 5% and volumes rise by 8%. And there was no cost to you of the 5% fall, then you've got all the benefit of the 8% volume. And that's your world. But the answer is, anybody else knows that a washing machine and a dishwasher doesn't go down by 5% anymore, it goes up by about 6%. And actually, the reason you buy a dishwasher or a washing machine is not because it's cheap, it's because your last one's just broken down. It's a replacement cycle. And the last thing you need to do is to kill each other over a 6% margin, which you used to have, because there used to be 26% margin, not 20. Actually, the general public, may not like it, but the price of being 6% higher means you're in business rather than not in business. But it's fascinating because those two companies are valued at nothing in the market because there is still two people out there who want to kill each other and wrongly. And so my skill set some of it is understanding how to navigate this thing. Some of it is really just going to these people and banging their heads together until they work. Because one of the points is they give you an idea. And it goes back to what we were saying early on. The CEO said, well, of course, we're quite pleased because, we're nearly back to the 19 billion of sales that the industry had in 2019. I said, but you've got to understand that the RPI since 2019 is now up 17%. So your 19 billion should be 21 billion. And it's just this. There are just so many instances where the people have to. They've got to start thinking in a slightly different way.
Well, Chris, we've really enjoyed your thoughts and your contrarian view, and I challenge anyone who's listening to this to actually call it overly contrarian, because 3-4 months of interest rate rises when inflation's in double digits is just certainly not enough. And just the handful of companies that you've mentioned today, the amount of opportunity in this market is amazing. I'm conscious of your time, given you're just starting your day. So look, we're going to watch you with interest, and we're going to actually watch you with, hopefully, by being investors ourselves as funds and our clients, and we're really going to enjoy the journey. And I just wanted to thank you on behalf of everybody listening, thank you so much for sharing your thoughts. It's been a really special occasion for us, and we really appreciate it.
And thank you, James, and everybody. And I hope we'll come back and do this again. It couldn't be more pleasurable.
All
right. Thank you very much, James. God bless.